welcome to the ICICI Prudential Life Insurance Company Limited 9 months 2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that the conference is being recorded. I now hand the conference over to Mr. Anup Bagchi, C and CEO of ICICI Prudential Life Insurance. Thank you, and over to you, sir.
Yeah, thank you. Good morning and welcome to the results call of ICICI Prudential Life Insurance Company for the 9 months ended December 31st, 2023. Several of my senior colleagues with me on this call. Amit Palta, who heads Distribution, Brand Marketing and Products. Dhiren Salian, CFO. Judhajit Das, who heads Human Resources, Customer Service and Operations. Singer, who handles Audit, Legal, Risk and Compliance. Manish Kumar, our Chief Investment Officer. Avik Jas, Corporate Actuary. And Dheeraj Suga, our Chief Investor Relations Officer. If we take some of developments during the quarter, before moving on to discuss the company's performance. On the regulatory front, IRDAI has issued an exposure draft on product regulations for public consultation. One of the key elements proposed is the concept of a premium threshold on non-linked savings products. Beyond this threshold, no surrender charges shall be levied on the remaining premium, irrespective of when the policy is surrendered. We believe that any changes leading to a better product proposition for the customers would be a great opportunity for the insurance industry. In line with the same, we have launched ICICI Pru Guaranteed Pension Plan Flexi with benefit enhancer, which is first annuity plan that provides customers with an option to receive a 100% refund of premiums paid at any time starting from the day of purchase. Significantly, this product, in line with proposed regulations, aims to ensure that the customers receive a fair and appropriate surrender value, particularly in the event of an early exit from the policy. For distributors, while the base level commissions between the various variants Flexi are similar, in the benefit enhancer variant, the commissions paid have bracketed and more level based for initial years. The IRDAI has expected to use Bima Trinity for insurers. Includes Bima Sugam, Bima Vahak, and Bima Vistar, with an objective to reach the last mile coverage by leveraging technology and customer-centric initiatives. The Bima Sugam platform is supposed to be a non-profit company, and we are set to invest in the platform as a founding member. The platform aims at providing an end-to-end digital solutions for insurance purchase, service, and claim settlement in a seamless manner. This is a welcome initiative since it will be a one-stop destination for customers to fulfill all the insurance needs, and it also gives a platform for all stakeholders to participate. Innovation has been core of our business strategy. During 2023, we launched a slew of innovative products such as ICICI Pru Gold, Gift Pro, iShield, Protect. We also launched industry's first ULIP net fund with constant maturity as a theme. During Q3 2024, we launched waiver of premium rider, which allows customers to get policy benefits even if an unfavorable event occurs to them. On the protection side, we have launched ICICI Pru iProtect Smart Life Continuity option, again an industry first feature where the customer has the flexibility to either receive the sum assured as a lump sum or a monthly income for a duration of up to 3 years or a combination of both. And of course, we spoke of ICICI Pru GPP Flexi with benefit enhancer a while back. On the process side, with a set of capabilities encompassing digital and analytical capabilities, we were able to issue approximately 40% of policies on the same day for the savings line of business in Q3 2024. Implementing this, we have launched an initiative of crediting commission on the same day of the policy issuance for top-tier advisors. In the last earnings call, we had detailed out the ICICI Pru Stack, which is aimed at making us the most sustainable insurer, and initiatives like this further add to the overall proposition to our partners. Third, I would also like to talk about the claim settlement, which is the moment of truth for any insurance company. As a customer-first brand, I'm pleased to inform you that the company has consistently maintained an impressive claim settlement ratio of 97.9% in Q1 2024 and 98.1% Q2 2024, securing the top position amongst private sector insurers. Along with that, our average turnaround claim settlement time now stands at 1.3 days for non-investigated claims in 9 months 2024. Fourth, as a testament of our efforts on investing in digitalization and data sciences, we have awards for the best use of emerging customer service, transformative security initiatives, best innovation and diversification. The company's 2023 annual report too has received the Gold Award for 2023 Spotlight Awards by League of US Communications. Recently, we have been ranked number 1 term insurer by Fortune India. Lastly, on the sustainability front, we are to be the highest rated insurer in India with AA rating by MSCI and have received awards for sustainability report and overall sustainable performance in BFSI. Our complete list of awards won in Q3 2024 is presented in slide 43. I will now move on to discuss the key performance snapshot for Q3 2024 and 9 months 2024. 9 months 2024, value of new business was 14.51 billion in APE of 54.30 billion. VNB margin stood at 26.7%. The decline in VNB margin is primarily on account of the shift in underlying product mix towards unit link and par from non-par business, decline in group term business and higher expense ratio for the current year. We have registered RWRP growth of 10% in Q3 2024, higher than average growth rate registered by the overall industry as well as private life insurers. On the proprietary business, that is direct and agency, constitutes more than 50% of our retail AE. In this, direct business has grown by 18.8% for 9 months 2024. We have been investing in agency channel by scaling our frontline managers and providing our agents with institutions complemented by data analytics and data capabilities. The agency channel has grown by 12% year-on-year in 2024, and our efforts are directed towards driving this growth further. Partnership distribution has registered a growth of 11.2% year-on-year in 9 months 2024. Banca channel grew by 2.4% year-on-year in Q3 2024. Within that, ICICI Bank channel declined by 4.8% year-on-year. The group channel declined primarily on account of group term business, while we saw sustained growth in the group credit life business. On the product side, in 9 months FY 2024, linked business has grown 2.7%, while non-linked savings business has declined by 2.5% year-on-year, primarily on account of shift in customer preference from non-participating products toward participating and ULIP products. For greater than 5 lakhs ticket size category, they witnessed growth at company level within the overall RWRP for Q3 2024. Annuity business grew by 17.3% year-on-year in Q3 2024, as of strong growth in regular premium annuity. The group fund business declined 0.1% in 9 months 2020. The retail protection APE continued to witness strong growth. We ended 9 months 2024 with 55.9% year-on-year growth. With this, we have surpassed the FY2023 protection. Our regular and limited pay persistency have been improving consistently. 13-month persistency stood at 87.4% and 49th-month persistency stood at 67.1%. Our cost to WRP ratio for savings line of business stood at 6.3% for 9 months FY 2024 as we continue to invest to deliver sustainable growth in the future. We have always ensured that customer centricity is at the core of everything that we do, and we have been continuously working on improving the customer-related metrics as detailed out in slide 7. We believe that the key to market expansion is in getting the customer product channel equation correct, which means the right and simplified product to the right customer at the right price to the right time. Additionally, we have taken major steps to become the most partnerable insurer in the industry. And with the launch of ICICI Pru Stack, we now have an array of platform capabilities available for our customers and our partners. enhancing the distribution and acquisition of new partners and new sourcing channels, setting up the platform for long-term sustainable growth. Our product, process, and distribution is completely aligned with one goal, that is to deliver value proposition to our customers. Hard work done through all these years is expected to start bearing fruit in the shape of steady growth moving forward. Our 4 key elements led by 4D framework continue to play a crucial role in the growth of absolute VNB. Thank you, and now hand it over to Amit to take you through the business updates. Amit.
Thanks, Anup. Good morning, everyone. As Anup said, our 4D framework what drives our 4P strategy. Our 4D framework has entirely in place by keeping in mind our core objective to deliver quality business in a risk-calibrated manner. Let me outline important actions we are taking to further strengthen this 4D framework. The first element is data analytics. We have been investing in data science over the years, and customer-centric analytics engine has been powering our sales and distribution, operations, business, and product strategy. Additionally, we are focused on extensive utilization of AI and machine learning, along with data analytics to mitigate risk in the insurance business. Our recently developed AI and ML-backed model has been assisting us to mitigate the fraud and early claims risk. This has led to 70% reduction in cases with higher propensity for fraud and early claims for savings policies for the period October 23, November 23. The same has been detailed on slide 30. The details of our extensive deployment of analytics capabilities are set out in slides 26 to 30. The second element, that is diversified proposition, has been detailed from slide 31 to 34. We have a comprehensive suite of products and continue to strengthen our product portfolio to address changing consumer preference in a dynamic environment. During 2023, we launched innovative products across categories. We also launched industry's first unit fund with constant maturity as a theme. The launch of ICICI Prudential with benefit enhancer in annuity, waiver of premium rider, ICICI Pru iProtect Smart Life Continuity option, as highlighted by Anup in his opening remarks, are a result of anticipating what consumer needs and delivering it accordingly. The third element, digitalization, has been detailed from slide 35 to 39. We have been working extensively to integrate our digital ecosystem with agencies to fetch KYC and income estimation details for a simplified digital customer onboarding. As a result, during quarter 3 FY24, around 40% of policies have been issued using digital KYC, and nearly 40% of our saving policies were issued on the same day. The fourth element, debt in partnership, is presented on slide 41. We continue to build capacity and have added more than 28,750 agents during 9-month FY24, spread across geographies. Within the bank and sourcing channels, we are setting up a platform for longer-term sustainability. Non-bank channel, we continue to add new partnerships and increase share of shop in existing partnerships. We now have a total of 42 bank tie-ups with access to more than 20,000 bank branches and more than 1,050 non-bank partnerships, with an addition of 144 non-bank partners during 9 months by 24. Through ICICI Pru Stack, we aim to become the most partnerable insurer, and we can onboard any new distribution partner in less than 2 weeks. Let me now talk about the business performance update to the elements of our P strategy. Starting with the first P, that is premium growth element, which is mentioned from slides 9 to 12. As you can see on slide 10, total APE for quarter 3 stood at 19.07 billion. For 9 months, it stood at 54.30 billion. As Anup has highlighted the channel and product-wise growth, let me highlight the business. Today, we have a well-diversified distribution mix with no single distributor, excluding ICICI Bank, contributing more than 5% to our APE in quarter 3 FY24. Hence, volatility in any single channel will not have any significant impact on our top line or bottom line. As you can see on slide 12, for overall 9-month FY24 APE, Agency business contributed 27.2%, direct business contributed 14.8%, bank insurance 27.9%, partnership distribution 12.6%, and food business contributed 17.5% to overall APE. This diversified distribution will enable us to grow sustainably in the long term. Along with channel mix, we continue to maintain a very diversified product mix with 9-month FY24 APE contribution from the linked savings product at 43.1%, non-linked savings at 26.8%, protection at 20.1%, annuity at 6.0%, and the balance 3.7% coming from group scheme products. The non-linked APE mix has declined from 28.6% in 9 months last year to 26.8% in 9 months current year, whereas linked APE mix has increased from 41.4% in 9 months last year to 43.1% in 9 months FY24. Annuity business grew strongly by 17.3% year-on-year during Q3 FY24. Single premium annuity declined as customers might have postponed purchases given high FD rates currently. However, strong growth in regular premium more than made up for the decline in single premium. Another important focus area for us is to serve the life protection needs of the customer. On this aspect, let me talk about second P, protection growth, on slide 14. With an APE of 10.92 billion, the overall protection segment saw a year-on-year growth of 4%, leading to an APE mix of 20.1% in 9 months 2024. The retail protection business has registered a strong year-on-year growth of 5.9% in 9 months FY24. This we have surpassed the FY23 APE in the current year's 9 months itself. We expect normalized growth going ahead in retail protection. Our total new business sum assured stood at 7.2 trillion for 9 months FY24, and our total sum assured stood at 30.3 trillion as at December 31st. We believe, given the current level of penetration, retail protection business growth is a multi-category opportunity, while credit life and group term business also offers significant opportunity as we witness growth in credit and economy. Coming to our third P, which is persistency improvement, presented on slide 16. We believe persistency is the most effective indicator of the quality of sale and is a barometer of customer experience. This is reflected in the significant improvement in persistency ratios across cohorts. We have developed AI models which predict future persistency behavior of the customer at various stages, and these enable us to take appropriate interventions. This will further help us to improve the overall persistency levels for business. Now moving on to the fourth P, which is productivity enhancement, presented on slide 18. Our total expenses grew by 28.3% year-on-year, 9 months FY24. As highlighted in the previous quarter, the increase in new business commission is attributed to redesign of commission structure pursuant to flexibility provided in IDA payment of commissions regulations. This year continues to be a transition year, and we expect the rates to settle down as we move to the next fiscal year. Rise in operating expenses is primarily due to sustained investment in capacity creation to support future growth. Our overall cost to TWRP stood at 25.3%, and saving lines of business cost to TWRP ratio stood at 16.2% for 9 months FY24. We monitor cost ratios for the saving lines of business separately. Our objective is to bring efficiency in the savings lines of business while we continue to focus on growth in the protection business. I will now hand it over to Dhiren to you through the outcome of 4P strategy and financial update 9 months FY24.
Thank you, Amit. Good morning. We regularly monitor our experience in respect of various risks, and diligent and prudent risk management framework we operate on is reflected in our strong and resilient balance sheet presented in slide 19. The emerging mortality experience is within our expectation. On the asset quality, 96.4% of the income portfolio is invested in instruments that are rated sovereign or AAA. We continue to maintain a track record of not having a single NPA since inception. Of our liability profile, 73.9% of liabilities largely pass on market performance to customers. We use derivatives to hedge rate risks in our non-participating guaranteed savings and annuities portfolio. Continue to closely closely monitor liquidity and ALM positions, and we have no issues to report. The VNB for 9 months FY2024 was rupees 15.51 billion. Given our APE of rupees 54.30 billion, the VNB margin was 6.7 for the 9 months. Decline in margin is primarily attributed to product mix shift and higher expense ratio for the current year. First, let me explain the impact of the product mix shift. The market buoyancy has led to higher growth of the ULIP portfolio, which, as you're aware, has a lower margin compared to the company average. Further, we've been experiencing a shift in product mix from of greater than rupees 5 lakh non-cases moving towards the participating and the unit-linked. However, for Q3 FY2024, greater than rupees 5 lakh category, we have been able to see the market opportunity through unit-linked and participating products, and we were able to grow the customer segment in with company level RWRP. There has also been an interesting mix of traditional plans moving from non-participating to participating products, which has led to the par product mix to be higher than the non-par product mix for 9M 2024. Further, we have seen competitive pressure on pricing in both the non-par business as well as annuity business. Additionally, on the protection side, even though retail protection and credit life businesses have grown during the year, group term business has declined from the high base we had in the previous year. But there have been significant growth in the number of group term deals. The lower deal sizes reflecting normalization of rates post-COVID have led to a decline in the overall APE of group term. Second, the higher expense ratio for the year has also impacted margins. The growth in the top line for the 9 months has been lower than the planned numbers. As explained earlier, the redesign of the commission structure has led to an increase in commission expenses. We have also continued investment in capacity creation to support future growth, specifically in the proprietary channels, that is agency and direct, as well as in IT and brand awareness. This has led to an increase in operating expenses for the year. Further, from a Q4 perspective, we are now looking towards the double-digit growth, which can help absorb some of the costs that have been incurred in the current year. The assumptions, we seem quite comfortable on both persistency and mortality experience, and as with the usual practice, we will evaluate them at the end of the year. For the coming year, we believe all investment and diversification that we have made will help delivering the APE growth, which will aid in growing VNB. Coming to other financial metrics, the profit after tax grew by 18% year-on-year from rupees 5.76 billion in 9 months FY2023, rupees 6.79 billion 9 months of this year. Our assets under management at rupees 2.9 trillion, and our solvency ratio continues to be strong at 196.5% at December 31st. To summarize, we will continue to make progress in the 4P framework of premium growth, protection business growth, persistency improvement, and productivity enhancement led by a 4D framework. We are now well diversified in terms of product and distribution mix, which allows us to manage the impact of the external environment in response to shift consumer preferences. Thank you, and we're now happy to take any questions that you may have.
Thank you very much, sir. We will now do the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only hands while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avinash Singh from Global. Please go ahead.
Yeah, hi. Good morning. Couple of questions. The first one on your margins. I mean, on as it is basis, if I look at the changes, they fail to explain. So that means either the value proposition for the policyholders has changed materially for the same set of products, or the overall cost, acquisition cost of X has shifted a lot, that is leading to certain dip in the margin. So if you can help explain this sort of, how much of product value proposition change for the policyholders, or and how much it is because of acquisition cost, and if the large part was due to acquisition cost and OPEX, I mean, I would expect you to have a bit guided because you know that, okay, how your office is going to go based on your strategy. So a bit of guidance because this margin suddenly is big. So that's question one. Second question is more around growth. If I heard correctly, you are saying beyond before you are looking at double digits. So I mean, if you can just sort of try to explain the various construct for what is, because I mean, we are also in the era of some regulatory uncertainty going on. So what gives you confidence for double digit growth beyond Q4, and what sort of number of growth you are looking for Q4? And just one minor again. If I were to look at retail AP, retail WRP growth, some minor gap, I mean, percent. Is it largely, I mean, a quarterly, monthly premium payment kind of that sort of a short number and will normalize over the quarters, or is there something more? Thank you.
Good morning, Avinash. So, Avinash, as I explained earlier, the shift you see in the margins is on, again, two fronts. The product mix, what you've seen here is the shift towards unit link. That has definitely happened. What you've also seen what you've not been able to see because we've not given a split between par and non-par, clearly is the shift towards participating. If you recall, we had initially spoken of last year's par to non-par mix being roughly about 1:2. That has shifted more towards the participating side, where the participating actually is larger than the non-participating side. That shift product mix also has a great part to play. The other aspect, as we also pointed out, competitive action in the non-participating space as well as the annuity space clearly have led to compression of margins on that line of business. So to that extent, there is of course a depletion that comes through. Coming to operating expenses, yes, we've seen operating expenses a bit higher. We had forecast growth for the full year. We've not been in a position to deliver on the growth for the 9 months so far. You can see that it's a little over 1.5% for the 9 months together. That has impacted the unit cost for the lines of business, and which is what we are reflecting at this point. Coming to your second question, in terms of what are we looking for quarter 4, we are seeking to look at double-digit growth in terms of APE. We've looked at this primarily from the perspective that if you look at quarter 3, we do have a double-digit growth on retail business, or the RWRP growth about 10+%. We expect that for the coming quarter as well. Initial trends that you see in the first 2 days of January seem to be quite positive, which is what gives us confidence that we should be working towards this.
Yeah, and given that, of course, you have that last year March base effect of pricing policy. So what for growth, I mean, adjusted for that or not adjusted for that, you will see for Q4?
We are seeking to double digit on this for Avinash.
On that base, on the reported base, or just some kind of,
Reported base.
Okay, reported base you are looking at. And just last, bookkeeping question that was your RWRP and retail AP, or individual AP reported will be happy because of this quarterly premium paying accounting time.
So there will be a gap between RWRP and AP from a monthly model perspective.
Okay. Thank you.
The next question is from the line of Swarnabh Mukherjee from PNB Securities. Please go ahead.
Hi. Thank you for the opportunities. 3 questions. First one, as you highlighted in terms of the mix, I just want to understand also that, if I just, look at the mix in third quarter from a comparison point of view with the second quarter, then unlike if you could have compared 9 months to 9 months, if we do it just on a single basis, on a quarterly basis, then the mix does not look very different in terms of, say, how much is unit linked, how much is protection. Your point that par has increased very significantly vis-a-vis non-par in the non-linked mix. Is it fair to understand that this change has happened more in this quarter between par and non-par? Because I think some triangulation suggests that it could not move that drastically in the previous quarters. is it a phenomenon that has happened this quarter? And also similarly for in the protection side, how is the margin profile of group term life now playing out post the price correction? Because I think although it has increased, share of group term life on an AP basis in the mix have increased for overall protection. So if you give these granularities, so that is my first question. The second question is on the channel. So if you tell us how it has been between iBank and non-iBank this quarter, what split the bank IP in that, and given that you mentioned that you are gaining market shares in your partner banks, but despite that, I think we have done a 2.5% growth in AP in this quarter. So what kind of challenges you are facing there? Is this competitive intensity, or is this that banks are focusing on other product segments? If you highlight on that would be great. Also on the margin side, I just want to understand that do you think that product mix will kind of change in the upcoming quarters, or is the margin poor for the next quarters going ahead? So this will be my question. A quick question on the new product would be, sir, that if you could tell us what kind of VNB margin for the new annuity product you are bringing in, which has more trail kind of a payout model as you mentioned, and what kind of tax rates you are also taking in that estimation. That would vis-a-vis say a similar product with current kind of surrender charges. That would be very helpful for us to understand. So, that's all from my side.
Yeah, so I had a lot of questions. Let me try and pick them up. If we miss, please remind us. So on the first one that you spoke of on terms of Q3 margins, please understand the way the methodology is that you look at full year 9-month margins when you do the computation and you apply entire books at base itself. So typically when you just look at incremental Q3, it does have a catch-up impact of both Q1 and Q2 also. You're right, incrementally between Q2 and Q3 doesn't seem to be too much of a shift on the outside from a product mix perspective. But clearly, we've seen a shift across both the quarters, in fact, all quarters towards the participating line of business, away from the non-participating businesses. At this point, the participating is slightly higher than the non-participating for the 9 months together as well. Another point that I also cited was that across the year, we've had pressure on both non-participating as well as annuity lines of business, which have led to compression margins. Those are the key elements that are coming through. What, of course, we are reflecting also at this point is the expected unit cost, which has, given the higher operating expenses, is adverse to the margin. That also is reflected at this point. That's how the whole thing comes together. However, what I also, you pointed out, group term has declined. That overall, when you look at the protection mix of roughly 20%, whatever gains that we've had on the retail protection side, being offset by losses on the group term side. Group term specifically, again, has undergone some bit of correction in terms of margins as we've gone towards post-normalization of rates post-COVID and increased competitive intensity. They're working off a higher base, and itself is leading to a drop in group term.
I just want to add here, this is Amit Palta. See, we also need to understand the context of margins, the way it was operating on non-participating guaranteed products last year. While all of us have witnessed the hysteria around the guaranteed products in the month of March, also led to a lot of competition activity, competitive practices in terms of pricing, and the margin did compress during the period February and March because of competitive pressures. And we cannot deny the fact that a lot of affluent business, last year business, was preponed in the month of March, and there was a scarcity and there was a proposition for customers to prepone their purchases, which means that naturally there was a lull in Q1 when it came to guaranteed products, and IRR or customer returns had to get moderated eventually. So that moderation happened in the Q1, but however, level on margins had already got corrected at a lower side in last quarter. So subsequent to that, all the changes that we witnessed, whether it was mutual fund indexation benefit being taken away, and related to other investment products, unit link was attracted only a long-term capital gain tax in comparison to more than 5 lakh cases where regular tax was levied on the customers, meant that naturally the pull towards a high potential returns kind of participating product and unit link products started gaining momentum. So it was not just a quarter 3 phenomena. We saw it at the very beginning of quarter 2 itself, where participating in unit link products started gaining momentum. And slowly affluent business also, because of relative advantage that they had on tax, started gaining the overall mix, and non-participating products with moderation of IRR in the overall industry saw a bit of a compression on demand, which actually continued right through quarter 2 and quarter 3. Coming to group protection, see, for the years where we were doing very well during COVID, and we chose to be participating in group term business. The pricing was different level altogether. Post the experience, which was favorable, the pricing had to go through a correction. But yes, the pressure on the lower pricing meant that there was pressure not just on top line but also on margins. So margin on a standalone basis is still good, but not as much as what it used to be earlier. That is on the group term which I would add here. Back to you, Dhiren, for the second question, which is on mix between iBank and non-iBank.
Yeah, mix between iBank and non-ICICI Bank. This period is actually half-half. You know, ICICI Bank has stabilized. It's roughly in the 80 to 100 crore range per month, and it has set down. Actually, if you back out ICICI Bank from this, quarter 3 of ICICI Bank, business has actually grown by double digits. Coming to the other question on new product that we've launched and what kind of tax rate.
There was also a question on non-ICICI Bank business and the competition practice. I just want to add there. See, broadly, the way things have played out in bank insurance business is that wherever we saw traction and prioritization in alignment to unit link momentum and unit link demand, we saw those channels doing relatively better. So the overall pie was witnessing a moderate growth in multi-insurer banks, barring few exceptions here and there. But what we have witnessed is a growth which is quite reasonable and more than the growth at the individual partnership, which meant that the focused effort has actually started yielding us better share of business at the shop. The non-ICICI Bank business in terms of share has continued to look better for us.
Right, sir.
So let me cover the last question that you raised in terms of the new product. What kind of margins are we seeing? This will broadly be in line with the current of margins on the product variant. There are many large lapse rates of this. And because this is an offer making to the customer, which is giving them flexibility in case something does happen to them. This is not a product, this is not a core feature that people utilize. This is a benefit that is available to them, and the 100% they will get, or the surrender value that they will get out of it, is clearly beneficial to the customer in case they need the flexibility. Please understand that this product actually is saving towards retirement. And to that extent, if customers get the money during the initial period, then he has the flexibility to take all of that away, even though his retirement goal may get
Understood. And if you could respond on, about the margin on in, say, near term quarter or maybe going into the quarter next, do we expect it to remain in a similar range on a quarterly basis?
Yeah, broadly, if the product mix holds, then I think we should go along the same lines. Shift product mix are something that we have to account for as it goes through the quarter and the next year as well.
Mm-hmm. So if it remains broadly similar, so full year versus 9 months, we should see even a little bit more contraction from where we are. Would that be a fair understanding?
Swarnabh, the other thing also is we are trying to put in a double-digit growth. Right. So to that extent, if we overshoot it, great. We should have definitely some further. Otherwise, will reflect on the cost ratio at the end of the year.
Understood, sir. Thank you so much.
The focus will continue to be delivering on products which are good for the customer, and we'll allow ourselves to be aligned to where the customer demand is. And what we as an outcome is something that's where I would like to qualify and put it.
Sure, sir. Very clear. Thank you so much.
Thank you. Ladies and gentlemen, to ensure the management will be able to address questions from all participants in the conference, kindly limit your questions to one per participant. If you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Supratim Rao from Ambit Capital. Please go ahead.
Thanks a lot for the opportunity. So my first question is that, we have seen, what has happened over the, the last 9 months. It appears that, you are going for growth, but that growth is coming at the cost of margins. And is this a function of your, ICICI Bank channels not really growing, and hence you have to grow in channels where the competition is higher, and which is then adversely impacting margins? And so going forward, while growth to be double-digit, the top line grow at double-digit, the margins could be really lower than what we have seen historically. So is that the way we should think of business going forward? That's the first question I have. The second question is, you have made investments in, your agency channel, direct channel, but just want to know, whether these investments, how long will these investments continue for, and what level of top line growth do you need to see before, your operating leverage starts to improve? That's the second question. And lastly, on the new product, the benefit enhancer, just wanted to understand how does the margin on a benefit enhancer compare to normal variant? Those were my 3 questions.
Yeah, thanks for them. On your first question, I don't think that's the right way to look at it. Each distribution channel has chosen a strategy for the insurance business, and we respect every distributor's decision along those things. And ICICI Bank is nothing new. We've discussed it for many quarters now. That has been completely to the case. What is good that you're seeing at this point is that ICICI Bank has started to stabilize at 100 crore range, and that's where we believe it will be. This growth out of it, we will take it. We obviously have to work beyond ICICI Bank. We can't just be with just one primary channel. And one of the things that we have spoken of in the past that delivered is actually a very diverse channel as well as which allows us to take advantage of the opportunity as it presents itself. Whenever there is an opportunity, we are in a position to take it. So if there is a market buoyancy, unit-linked it is well for us. That of course, the product mix shift has an impact on the product margin. That's what we explained in the past few minutes as well. What is very critical for us is to make sure that we've got all products on the shelf, and we're in a position to offer them the distribution that is able to reach out to those customer bases. Whatever the customer chooses that is good for them, we will offer and allow that to pay out. Coming to your other question in terms of the benefit enhancer product we've launched, we just discussed that margins are broadly in line with what we're seeing for the other variant of the product.
And on the investments in the new channel and
You had asked a question on agency and direct. This is Amit. First of all, the focus on non-ICICI channel, which may increase our margins. I just want to clarify that of the retail business, 51% of our business is proprietary direct business, which is proprietary sales force and agency. So 51% of the business is not purely a multi-insurer competitive business. It is only around 40% of our non-ICICI Bank insurance business and another 50% of partnership distribution. That leaves us with around 30% of our business, which is actually multi-insurer. The rest 50% of our business is close to being captive or proprietary, they call it. To that extent, in fact, I ICICI Bank decision on our strategy will not have an implication on margins because of business increasing on the other side of it. Specifically on our investing in direct and agency business, we continue to invest. I think last year and a half, we have really scaled up our capacity to start licensing more advisors through investing in people, processes, and also institutionalizing on digitization support to our agents. And this is a process. This is starting. As you know, that gestation period for setting up capacity to deliver productivity takes a little time in agency because the cycle involves not only self-train but also hiring and then making agents productive. And hence the cycle is a little longer. The good news is that Q3 we saw a good double-digit growth in agency, which is close to 2%, and investment on capacity will continue at current pace, and we don't intend to pull back our capacity addition in agency. Direct business is quite on course. It's growing at 18 to 20% for us. It includes both upsell as well as what we are doing on our website. So that business is quite on track. Back to benefit and some margin.
Yeah, we just discussed that. Yeah.
I want to know what top-line growth that is needed for the operating leverage to flow through. Get that.
Yeah, that's a little difficult to estimate because we obviously would want to invest in our business as well, but really we don't want to let go of the opportunity. So we'll have to calibrate both along the way, both in terms of how top line emerges, kind of investment we continue to make. So difficult to put a specific number to it.
Got it. Understand. Thank you.
Thank you. The next question is from the line of Pankita Srivastava from ABSLI. Please go ahead.
Thank you for the opportunity. So the first question is on, so I want to understand what percentage of business, the new business that has been generated is coming out of the captive iBank in terms of group credit life. That's the first question. And what are the other bank partners that they have in terms of diversification? And you mentioned the AUM as well, the ICICI Bank, ICICI Prudential. So I wanted to understand what is the group AUM out of this? What is the percentage of group AUM out of this? Thank you.
On ICICI Bank's share on credit life business, though we don't publish this, but it is in a double-digit share on the overall life business. Specifically, if we were to exclude non-MFI business and look at only non-MFI business, basically mortgage, they are around 20 to 25% kind of range.
So in terms of the AUM, we're largely retail. There is a group AUM. I don't have the numbers with me at this point.
Okay, sure. Thank you.
Thank you. We would request participants to kindly limit their questions to one per participant. Thank you. We'll take the next question from the line of Adarsh from Enam Holdings. Please go ahead. Mr. Adarsh, I have unmuted your line. Kindly proceed with your question. As the current participant is not answering, we'll move on to the next question, which is from the line of F. Frederick from Sundaram Mutual Fund. Please go ahead.
Hello. So thanks for the opportunity. Sir, again, kind of a question. So from a individual product perspective, on a sequential basis, has our margins changed?
Jobs, the larger impacts have been on the non-participant and the annuity side. Sequentially, yes, the product margins have gone down because they've reflected a higher cost ratio.
Okay. And sir, to validate, you mentioned that assuming that double growth holds up in 4Q, for the year we'll can end the 27% of margins, right?
We're working towards it. Where the margin finally ends up, we will see. Margin is not the primary focus for us. Absolute VNB is what we're gunning after. And again, whatever is the opportunity, we will go after it. We will offer that appropriate customer segment. we let the margin evolve from there.
And so from a slightly longer perspective, are we having any goalposts or do we intend to have any goalposts in the near term, like doubling of VNB, etc., since we have
No. As of we've not put out a metric of that nature. I think what we're seeking to do is to build on sustainable growth quarter after quarter. Green shoots are visible at this point. We've seen the fact that we have lagged the market quarter one, quarter by a large degree, and in quarter three on the business we have now come back on par and slightly above. Our focus largely is on the profitability side to work absolute VNB, and growth in absolute VNB is all we're looking for. Margin will evolve based on the final product. But the biggest driver to absolute VNB is on growth, and you're starting to see those green shoots come through.
Understood, sir. So that's it from me. Thank you.
Thank you. The next question is from the line of Sanket Godha from Evans Park. Please go ahead.
Yeah, thank you for the opportunity. During the question, you said that you will probably achieve double-digit growth in fourth quarter. So if I do a Q2 growth, honestly, that is almost like doubling the AP what you have did in third quarter. And if I look at the historical, we never grew at it on sequential basis for the fourth quarter. So just wanted to understand, since you are gunning for the number that on a higher base, there should be some confidence in some channels which is giving you that growth will be achieved. So just want to understand where this growth will come from. That's point number one. And if you manage to deliver that number in fourth quarter, then what kind of growth you can expect in FY2025, even given these channels will deliver growth for you? That's the first question. The second question is that on margins you have highlighted that just due to few reasons, but just want to understand on margin. I think we report margin based on projected cost, and given the cost has gone probably is more. Have we repeated the project cost assumptions in 9 months and reflect in the margin compression? And finally, if you give it in full year, but if you can give it now, it will be very appreciated. That VNB margin waterfall, if you give it because of the mix change, and product level margin which you highlighted is because of non-par and annuity. If you give the waterfall, it will be and assumption if it's there any. If you can give the waterfall, will help us understand where the margins have led to compression. That's it from my side.
Sanket, let me take the question first. Yes, we have reflected the higher expense ratios, the 9-month numbers, and close into our expectation of unit cost for the full year.
So the number is higher compared to what it was in 1H. I just wanted to understand that.
The unit costs are higher than what we saw earlier at 1H.
Okay, perfect.
That's right.
Specifically your question on growth expectations in quarter four. Let me just trace back last quarter. If you remember, the entire traction in last quarter was built actually in the month of March only. Jan and Feb were quite moderate in performance. So that is what I just wanted to clarify. I remember till the end of February, we used to go to the market saying that we had not seen the impact of scarcity, even till the end of February. To that extent, January and February were quite moderate on overall numbers, and it was only the month of March. So to that extent, I do agree that March scaling up at 10% growth will relatively be a challenge. However, January and February are expected to be much better than last year, January and February. Apart from that, your question on where the growth will come from, it will be a combination of what we do on products and how we have invested on channels over a period of time. And we do expect some of the initiatives taken on productivity and the maturity that we are seeing on the capacity added will enhance our productivity starting January, March. So it's been now almost 18 months that we have invested in capacity. We do expect some of the productivity to unfold in our favor proportionately in the months of January and February. So that's how the expectations are built. And of course, it is not just about channels. It is to be a combination of what we do on products as well as specific interventions that do with unique channels within bank insurance as well as non channels.
So, Amit, if that is the case, then utilization on a benign case in F5, we can expect growth in mid-teens because you are confident to deliver 10-11 in current quarter or fourth quarter, then it should fall down to mid-teens of a growth in F5, right?
The endeavor is, Sanket.
So we'll work towards that, Sanket, into the coming year. The idea is to be able to build sustainable growth every quarter.
Got it. And lastly,
Sorry to interrupt.
Sure, not a problem.
Kindly rejoin the queue. Thank you, sir. Thank you. We'll take the next question from the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity. On the margin, still I'm not able to understand that actually happening this quarter because the cost pressures were already visible in H1. Of cost actually has declined sequentially in absolute number. The growth has been better than the previous quarters. So what actually happened in this quarter which necessitates us to lower our margins? So have we lowered the pricing significantly in our non-products? Or what specifically has happened in this quarter? I want to understand. That is one. Second is, what will be the impact of surrender value regulation? So you mentioned that the margins of Flexi is broadly similar to the overall margin of the company, so which means that that's how we should look at the impact of surrender value regulation, or you expect any other impact of regulation? These are the questions.
Yeah, Nitish, just to point on margins, reflecting unit cost ratio at this point, it's affecting all the quarters as well. The key point is if we're able to deliver on growth, then we should have been able to absorb the additional costs. We saw that quarter 3, the growth was roughly about 3 to 4% on the overall AP. If it was higher, then we would have been in a position to absorb that. Given our outlook, now reflects some of the extra that we have in current mathematics at this point. With respect to CPC Flexi new variant, the margin of the variant is similar to that of our existing variant, not that of company average, but that of the existing variant. That's the key point. In terms of where the surrender value regulations will go, I think they're still at a draft stage. Let that evolve. However, we've decided to step forward and make this product variant available because we think that from a customer perspective, the objective that the customer would have in this product, which is till maturity until the time that they want to draw their annuity. There may be situations in their lives which may necessitate a withdrawal of fund, and we want to give this advantage to them.
Just follow up on that to maintain the margin of the.
Mr. Nidesh, your voice is being soft.
Hello, is it better?
Yes,
is it better now?
Continue.
Yeah, so just follow up on this. Are the IRRs lower, or have we reduced the payout to make the margins better?
The key thing, Nitish, here is that we've back-ended the commission. So it's actually far more trail-based, not upfront, which is the structure with most products where it is higher in the first year and lower in the subsequent years. In this particular product, we have made it on a trail-based format.
Thank you. That's from my side.
Thank you. A reminder to all the participants to limit their questions to one participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Thank you. So I have two questions. First is on the commissions. So for the quarterly, for first quarter, second quarter, third quarter, your commission YOY growth has rapidly picked up, and third quarter is up about 150%. Now, the only other peer of yours who has reported their numbers, they also have elevated commissions, but their year-on-year growth was sort of similar in the past. So are there any channels or specific reasons why your commissions have done much more rapidly in third quarter, or I just want to understand where this comes from. And on just continuing the point on the surrender value regulations, sir, any help you can give us on timelines, when you expect this to come up will be useful. And so just one last question on life.
Yeah. So, Shreya, on the second point that you raised, which is the surrender value regulation, it's still under discussion, so I'm unable to share any timelines at this point. In terms of the first question that you raised, the commissions would be reflective of channel mix that are underlying. It is company to company, and again, quite difficult to draw a direct comparison across each of them. Coming to your third question, credit life has grown strong double digit in the quarter as well, as it has through all the 9 months of the period. We're looking at 20+% growth.
Sure, sir. And just on the, so any channel of yours which is causing the higher growth for you, just for you, if you don't compare with any other player, any channel which is increasing the commissions much faster, that could help us.
So elements of wherever there's a multi-insurer, there is a higher commission growth there.
Got it. Yes, it is useful. Thank you.
Thank you. The next question is from the line of Nischint Chawathe from Institutional. Please go ahead.
My question. I'm actually a little confused on your guidance. Are you sort of for the month of Jan and Feb next year, you're looking at a double-digit growth, or are you looking at a double-digit growth in the month of April? Because as we discussed earlier, it's almost doubling of business on a quarterly basis.
Nischint, we're looking at for the quarter. For the quarter, not just individual months.
And any specific channels where you are looking at any acceleration?
You mentioned, Nischint, that it's going to be a combination of products and channels. And some channels where we have invested in capacity, we would see productivity unfolding in the last quarter. But again, it's not specific to one channel that we are focusing on. It's going to be diversified effort across our bank as well as non-bank partnerships, along with direct distribution. And of course, there will be interventions and initiatives around products.
Commission side, are we sort of saying that this is designing of commission structures, or is it that at the realization level, probably some of your agents are better off this year versus last year?
Didn't get your question. Can you just repeat that?
No. So on the increase in commission expenses, is it sort of more of designing of commissions, or is it something that agent realizations are better this year versus previous years?
So it is a redesign of commission pursuant to the guidelines. That's the larger component. And in some channels which have done well, we've seen that commission numbers grow as well.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal Financial Services. Please go ahead.
Hi, and thank you for the opportunity. Firstly, when you say the pricing or the competitive intensity in the non-par segment has increased, what would be the kind of how would you place yourself in terms of IRRs versus the competition? And is there any major correction that you would have done in this quarter that would have caused this? And second question is, when you talk about a 10% growth YOY in total APE in Q4, I'm just trying to understand out here the macro factors will not change materially in the next possibly next 2.5 months. What gives you that confidence that things like the intensity would use, or some of the channels would really kind of pick up momentum? And you alluded to the fact that you have invested in capacity and that utilization will improve in Q4. We put some examples out here as to which channels, what capacity utilization will increase. Some examples around that would be helpful. Thanks.
So, Prayesh, this is the product question, the margin question that you raised on the non-par. That's reflected through the year, not just this particular quarter.
Okay.
And that is seen, and we discussed this earlier as well, when you've seen the overall margin company shift has been on a product mix as well. So really it has gone away from the non, but wherever non, that those margins started to fall. the year.
Okay.
In terms of growth, clearly we've invested a lot of channels. We've invested in our proprietary channels. We expect some of that to come through. We're starting to see that growth come through even in quarter 3. And that's what we expect to carry through into the quarter 4 as well. And again, as Amit explained, it is going to be a combination of product and channel as we play it out the current coming quarter, to be able to deliver on double-digit growth for that quarter.
Thanks.
Thank you. The next question is from the line of Madhukar Ladha from Nuvama Wealth. Please go ahead.
Hello. Morning. Just, I wanted to understand, because I'm not getting a sense, has there been a big redesign in commission structures from channels? What is driving growth for you? Because if you look at the income statement, there's a steep increase in commissions. And, of that 28% growth in total expenses, what do you attribute, I know cause commission, but the whole EOM framework has also changed, so there might be some reclassification. What would you attribute to sort of cost going up, and what would you attribute commissions in that sense? And second, what are we saying structurally are margins going to be off over the, how do we see sort of VNB panning out over the next 3-4 years? And also beyond 24, what sort of top line growth should we expect, let's say over FY25 to 27 if we were looking at same frame? Those are my questions.
Yeah. So Madhukar, on your first question, yes, commissions have been redesigned across all channels, and that is what is the reflected number you see on the growth in commission levels. In outside of commission, we continue to invest in building capacity, especially across the proprietary distribution, agency and direct, as well as within IT and bank. You've seen some of those numbers also pan through this particular year as well. If I look at where we stack from the next year's perspective and then on, very clearly, focus is on growing absolute VNB. This year has been a bit of a flux year, especially when you look at the entire commission changes. We expect to settle down as we get into next year. But having said that, I think the key objective for us to be able to grow absolute VNB. And again, the core driver of absolute VNB will be from fee growth. And as we have spoken earlier, the objective is to be able to deliver on sustainable growth. Let's see where the final number comes at. But I think we'd want a steady number for the coming quarters, even in the range of 10 plus 50%.
Understood. And structurally, then we should start building in lower margins, right?
Sorry to interrupt. I would request you to kindly rejoin the queue, sir, for follow-up questions.
Sure.
Yeah, if I could just answer him as he trails off, I think we are not looking at VNB margin guidance, right? We've discussed that earlier as well. We go depend upon the product that finally evolves. Again, it goes back to the fact that we want to offer all products that are relevant to customers. Depending upon the environment, customers will choose what product suits them best. And we are not putting a hard boundary across any of the product lines. Thanks, Madhukar.
Thanks.
Thank you, sir. The next question is from the line of Mohit from BOB Capital. Please go ahead.
Yeah. Thanks for the 2 questions. If I look at agents, we have hired around 27 agents in 9 months. If I look at the net numbers, it was flattish. So I think that amount of agents has been created. I'm trying to understand what has been going on there. And my second question is in terms of the constant maturity fund. So you said that that kind of innovative offering. So last, I think we have launched that in May. So I just wanted to understand its response of the last 8 to 9 months. Yeah, thanks.
Yeah, see, constant maturity fund was launched at a time when indexation benefit on funds was taken away. So we look at that as an opportunity to introduce debt as an option within our unit-linked portfolio. And from then on, we actually saw a step from our affluent customer segments to pick it up specifically on constant maturity fund. Since it was a quarter one when we launched it, which was relatively muted quarter after a huge spike of business that happened in the month of March. So it was moderate to start with, but eventually now it is scaled to one of our actions that is continuing to mobilize reasonably well on a debt platform. Customers looking at debt as an option with a tax advantage on a unit-linked platform continue to choose constant maturity fund. So that is how I would like to answer. But at the same time, you will agree with me that small and mid-cap led rally on equity did take away the focus from debt to impact to equity towards the second quarter and the third quarter. So hence, what looked most relevant in the month of May and June, when debt indexation benefit for affluent customers was taken away, our constant maturity became the most obvious choice as the best relative advantageous product on tax efficiency. Eventually, it got replaced by buoyancy that we witnessed in equity products.
So Mohit, on your first question in terms of agents, yes, we've added nearly 30,000 agents. But the way we look at our agent force is that it doesn't really cost us to keep them on books. The way we look at our reduction in agent numbers depends upon, we take a slightly longer view on it in terms of their production. So it's only after a longer period of time when they have not produced, we look at them off the rolls. So to the extent, our philosophy on agent numbers are slightly different from the rest of industry. But clearly, I think what you should look at rather than agent numbers and then try and do an agent productivity, the absolute numbers generating and the growth that you're seeing out of the agency channel is we think more relevant. So to that extent, you see that in the last quarter, we've got strong growth on the business, and that's going to pick up now.
Right. Thank you. Just one question. Have we done pricing the rating action? And if you can just quickly answer.
So there is some element of repricing that happens at all points in time, depend upon segment. We obviously use a large degree of analytics to figure out what are the segments that we could offer pricing and differential underwriting processes on. And so that's a continuous process. So you could see some tweaks across product segments, across customer segments, even retail protection.
Correct. Thanks and wish you all the best.
Thank you.
Thank you. The next question is from the line of Yash Jain from CNBC. Please go ahead.
Hello. Can the management hear me? Am I loud and clear?
Yes, sir.
Yes,
please.
Hello. I just wanted to understand things. I need clarity on if I have to look at what is the ICICI Bank contribution to your AP in this quarter that compare to last year same quarter, and the share of ULIP out of your AP, where does it stand this quarter and last quarter? Second thing, if you could give us some guidance in terms of course, you've spoken about AP in the fourth quarter and the aspiration to work towards mid-teen AP in FY2025. But in terms of margins, do we see further issues from the current point as well? Considering there is that overhang of higher surrender value. What kind of margin do you expect that you expect as far as FY2025 is concerned?
Hi, Yash, this is Dhiren. So the share of ICICI Bank within the quarter, like we said, is roughly about 30-odd%. That's broadly been the case for the past 2 quarters as well. With respect to your question in terms of where the surrender value regulations are, they're still in a draft stage, so a little difficult to figure out who would come in. I think the industry representation is still on. So the final ones have not been notified yet.
Okay. And the margins, at the current levels, if translate in the way both in the draft, do we see further impact in the margins and what could be the quantum? I mean, an example of, if they actually come for the way they
I think the industry will anyway react. It's not going to be a poor situation. You've seen the example that we have done our own products. One of the products that we have recently launched, which is the CPP Flexi with the new variant. The way that we've handled that is to look at it from a tail-based perspective, where the commissions are more packaged. We keep margins broadly constant between this variant and the variant that we had launched earlier. So there are going to be, doesn't mean the industry will react. In any case, our exposure is quite limited to extent. There's a large portion will be felt on the non-link side, but we'll have to wait to see how this evolves.
And any guidance on the VNB growth that you expect for FY25?
No, there isn't a VNB guidance at this point. Our core objective is to be able to grow AP sustainably across each of the quarters. The product mix may evolve depending upon what customers choose. There are no hard and fast guidelines as to the share of business that we want from each line of business. The only thing that we expect is we going in the savings business. Within the savings business, allow the customer to choose the product that they like. So there is no VNB guidance. Fundamentally, what we're seeking to do is make sure that we grow sustainably across channels quarter to quarter.
Okay, thank you so much. And
thanks, Yash.
Thank you. The next question is from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hi, good morning, sir. Two questions. First, you mentioned that your high-ticket business from and PAR have more compensated for the other segments. I just wanted to get some color. Let's say if I just take the non-PAR category, what is the growth in the low to less than 5 lakh, be it for third quarter, or 9 months? And on similar lines on the margin side, you mentioned last year you had PAR non-PAR mix around 1:2 on the non-link side, and this time around PAR is more than maybe 50% for a 9 month. Would it be fair to assume that the ratio is more disproportionately skewed towards PAR maybe for the third quarter, which has led to the higher margin that we have seen? And lastly, coming back to the point on competitiveness on margins in the category. Structurally, let's say from medium perspective, if rates were to go down or because of the surrender charge circular, let's say there is categories where maybe the product becomes less relevant. Do you think that there is further headroom in terms of compression in margins for this product category for overall industry and for ICICI also?
So looking at the inter-se mix between PAR and non-PAR, last year it was roughly 1:2. This year is 50-50, but it's more towards the participant and the non-participant. It's not true that it has grown disproportionately in the current quarter. You've seen the shift of overall margins also come through in quarter 1 and quarter 2. It also reflects the lower margin that you see on the non-PAR business. What we have done significantly in quarter 3 now is actually to reflect the higher unit cost on the expense ratios that we see at this point. That's the only difference between H1 and 9 months. What is your second question?
The other question was on the low ticket non-PAR, how the growth rate on that?
Yeah. If we're looking at more than 5 lakh category, I think we have really not lost any steam on that. If that's the entire 5 lakh category customer, which is an affluent customer, I think putting all our lines of business together, we've actually grown. We've not lost that opportunity at all. In fact, the growth on that segment of business actually is in line with our company WR growth for the quarter.
So I was asking more from the less 5 lakh size on the non-PAR category, how good trends have been on that part of the business?
Yeah, that has declined. That is lower than the decline that you see in the more 5 lakh category for the non-linked.
Lastly,
question in terms of where the margins would be for non-PAR going forward if yields were to decline. If the industry does not reprice, then of course there will be a cut on the margins on that segment.
Thank you and all the best.
Thank you. Thank you. The next question is from the line of Agam from Flute Aura. Please go ahead.
Hello.
Yes,
Hello, am I audible?
please proceed.
I just had one question, sir. What's the embedded value as of December?
So we bring out our embedded value twice a year. So we had that at September, and we'll bring that out at the end of the year as well.
Thank you so much.
The next question is from the line of Neeraj Toshniwal from UBS. Yeah, please go ahead.
Hi. So just want to understand the non-linearity between the, P and VNB growth. Earlier, obviously, when we had a lower AP, we were still growing on the VNB. Now, given the mix is changing and obviously have the cost pressures, there have been significant impact on margins. But how do you see this going forward? Would we be able to grow in linear terms in AP, or that again, there could be some impact going forward?
Hi, Neeraj. So you're right. Over the past 2 years, we've seen the VNB margins improve fundamentally based on the product mix. At this point, you're seeing that the product mix is adverse to margins, and that is how it is played out. Of course, as we look at 9 months, there has not been too much of an AP growth. The expenses being higher. The higher unit costs have been reflected at 9 months. How do we see this going forward? Again, we have no margin guidance. Fundamentally, we want to make sure that we grow sustainably on the AP front quarter after quarter. And very clearly, the idea is to be able to offer all products to customers and let them choose what suits best. We'll work with our distribution channels to identify those customer segments, make sure that we have the right product market fit within those particular pools, and ensure that we work with our distribution teams to be able to deliver on growth.
And is there any cost difference substantial between the channels? There are people doing and the cost is going to be higher, so that is adversely for us.
Overall costs have gone up. I think they've not kept pace with overall AP growth. That is fairly visible. That is what is being reflected in the unit cost.
No channel to kind of add.
No specific channel to add to.
And sorry to harp on the same question on the AP. Given 9 months, we had a very big base last year. We did very flattish AP. Now we have a higher base. So we are, guiding on for double-digit AP for. I understand for next year onwards, probably the base would normalize. But what is, Jan Feb could be, little, but March, I think we have not called out for the one-off impact of budget. So before that or without adjustment, how do we see to kind of being delivered? Still a little confusing at the time.
Couple of things. One is the that we're looking at seems quite favorable to us at this point. So we want to carry through that run rate as we exit the quarter into the cancer period, where the cancer period has been far more benign. Of course, March is quite large, but we hope to be able to cover everything up and we get to the March period.
Any roadmap to that?
I would request you to kindly rejoin, sir, for follow-up question, please.
Sure, no problem. Thank you.
Thank you. The next question is from the line of Rishi Jhunjhunwala from IIFL Institutional Equities. Please go ahead.
Yes, thank you. Just one, point. You tell us, say, in 3Q, what would be the commission that would be paying on first-year premiums in non-linked products? My back-of-the-envelope calculation suggests it could be as high as 78%.
Not necessarily.
Any range, sir? Where would that be?
We've not brought out those numbers. I don't think it's high.
Okay. Thank you.
The next question is from the line of Ashwani Kumar Agarwala from Edelweiss Mutual Fund. Please go ahead.
Morning, sir. It's very good to know that we are very much customer-centric and offer products. But as shareholders, we also like to know the profitability that which we can achieve. So going forward in the Q4, do we expect margins to improve up from here onwards, or the VNB growth should follow the AP growth, or should be lower than that?
So Ashwini, thanks for the question. I think we're very clear that we want to drive on VNB growth, which is on the back of growth. The product mix will decide what the final margin ends up, but I think what we're clearly working towards be able to deliver on both of these parameters.
Because of 500 basis points margin, QOQ 500 basis point margin decline is much on the higher side. Life insurance is known as a steady business where things really don't move materially. But so a 500 basis point dent in the margin is never seen the last 10 years of the life insurance ever since they have been listed. That's why there is more anxiety in markets about how the margins can go down so much and what's the way forward. And how do we see the ROE going forward, and what are the challenges you see in maintaining the current margins, if at all?
So I think we've been able to reflect our expectation of unit cost into 9 months. That's why you've seen this drop across from Q1 till this period, which is roughly about 2+%. Very clearly, what we are wanting to do is to drive growth into quarter 4 in terms of AP. That should also reflect to what we are able to achieve on the VNB front then. Final numbers, of course, will depend upon where the product mix finally evolves at. But clearly, trying to build growth and followed up by consistent growth in VNB is what we are seeking to deliver.
Okay, and for FY25, we expect a bit of a growth in APE post the changes in the surrender value. Is there any absolute target, or it all depends upon the surrender value?
See, surrender value, again, let me just clarify, Amit, this side. Our exposure to products in attract surrender value is relatively much lower. And we do believe that as the regulations are yet to be seen in reality, however, we do believe that the impact of the same will be relatively higher on non-participating guaranteed products, which actually at current levels is close to around 11 to 12% of our business. So from that perspective, impact should be lower. But we'll see how we can structure managed margins through a differentiated commission structures. But right now, I will reserve my comments and wait for the final regulations to be out.
So my final question, how much of our profit is contributed by the surrender value the customers?
I think these are all based into the profit, into the product margins itself.
Okay. Thanks a lot from my side.
Thank you. The next question is from the line of Avinash Singh from MP Global. Please go ahead.
Yeah, hi. Thanks for the follow-up. Quickly, I mean, we know it's uncertain the timing and the final form of this surrender regulation by IRDA. Key idea, I mean, of the way I will read, basically, regulator is constantly pushing to improve or enhance policyholder value proposition or benefits. Of course, I mean, if you look at the three stakeholder, basically policyholder, shareholder, and your expert distributor and employees. Now, the IRT as a regulator is focusing more on the policyholder side. Shareholder returns so far have not been that great. They were coming great. Again, one or the other problem comes. However, if we look at the distribution side of cost, it is still very, very sticky. I mean, whichever form. So, I mean, your regulation changes the line item, but growth of the scheme. The distribution still remains continuing financial products. It still remains very, very sticky over the last 5 years, 10 years or so. Now, going forward, if we are still as a company growing on the higher OPEX and this distribution cost, any kind of a change to the regulation comes, probably that will again going to impact shareholder return. So, I mean, how do you see this distribution cost emerging over the years? Because there has not been much material change, barring ULIP. Of course, ULIP has seen a dramatic change. But on the non-linked side of it, the overall OPEX, including of the payouts, has not changed. And the regulator will consistently try to squeeze out more and more to improve policyholder benefit. In that context, I mean, how do you see this evolving, I mean, margins of the shareholder return?
So, Avinash, while we are not very certain when the regulations would come out in what form, because they're still under discussion in the draft stage. One thing is clear that if there is no action, then it flows through, and in terms of. But I think this entire difference would have to be borne by all stakeholders. One way to ease this whole thing out is to work with sale-based commission format, where the higher upfront is actually spread across the multiple years, which allows the company to also offer a higher surrender value to customers if needed to exit in the early periods. So there is one way this can work out. There are other formats in which it can play out, but I think still under discussion, so we're not very certain how they will all pan out. But I don't think that the industry and the distribution will be stagnant on this. There is clearly value that each of these products provide to customers, and they meet specific goals that customers have, which no other financial products can offer. So there may be, of course, a small speed bump at various points, depending upon how it finally comes through. But I think we've seen market industry adjust to the new reality. And as long as there is customer demand and you're able to make your proposition available for customer in easy to consume fashion, demand will flow through. So we are quite enthused that if this does come through, we know there are certain ways in which this can get managed. We have taken one step in this new product variant that we have launched. There could be other formats of taking this to market as well. We'll let that evolve as it goes by.
So, previous commission will have some impact on the new business growth. I mean, recycling or churn of the customer or policy is also part of new business. I mean, new business growth. So, if commission is lower incentive for the distributor to sell product rather than focusing more, that will again have some order impact, negative impact on new business growth.
But if you look at it from the customer's perspective, any reservations that they would have had to the product in the current form, where surrender values are quite high, the entire reservation goes away. And therefore, this product becomes far more attractive when you are saving for the longer term. That may itself propel demand.
Okay, thanks.
Thank you. The next question is from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thank you for the follow-up. Then you said that we have revised our unit economics in 9 months, but we unit economics, probably you would have factored in 10% growth this quarter, and that's why unit economics have been in. So for some reason, if the 10% growth does happen in quarter, then unit cost, what you will allocate to the policies will increase, and then there will be a possibility of the margin compression. Is my understanding right?
Yes.
Okay. And lastly, on this point, with respect to the non-ICICI Bank channel growth, the growth still seems to be a little lower relatively at 11% for the third quarter. And also I want to understand, do you see a material risk from IndusInd Bank? Because as you are, as this industry, it's common news that Hinduja Brothers have for Reliance Capital and probably will become more open architecture than it is today. Then when third player comes to IndusInd Bank, do you see a risk with respect to some growth in the channel?
So Sanjay, ICICI Bank at business actually grown at 11%. It's higher than what the market delivered in quarter 3.
But 11 we
not over that. Was it what we would have wanted? We would have wanted much more, no doubt about it.
Yeah, so specific to banks, other than ICICI and Standard Chartered, actually quarter 3 grew by almost 22% for us in quarter 3. So to that extent, it is quite robust. And I just wanted to clarify, when you look at specific distribution partners, ICICI Bank still is the largest distributor for us at 30% voting share. There is no other distribution partner which is crossed 5%. So to that extent, any volatility because of one partner will not impact the top line or bottom line. So from that perspective, we are quite isolated from anything happening on one front. As long as what is happening at IndusInd Bank, it's very difficult to comment because not heard from them on any change in their direction on strategy. Cross the bridge when we come to it. Anyways, in an intermediated business, clarity always incidents, and there are enough examples of that. And our job as a manufacturer is to keep manufacturing, keep supporting, keep enabling our partners through our partner stack and help them grow and increase their revenue pie. So we'll add new partners, we'll make existing partners more productive. If somebody has a strategic compulsion to move away and do something different, be it, we have seen it, we have witnessed it over a period of time, and we'll cross the bridge when we come to it.
And frankly, that's the whole advantage of running a very diversified distribution. We are not swung by the vagaries of one particular distribution channel.
Got it.
The ability for us to be able to work with each distribution partner gives us the flexibility to run with our strategies.
Then last one, in individual protection, means financially on special basis, there is a bit of slowdown. Means we did 1 crore in second quarter, we closer to 105 crores in the current quarter. So is it fair, because now you will have a recently big base for FY2023. So the kind of growth we delivered in 1 or 9 months, can we say that it will incrementally tone down relatively because it will king?
Yeah, actually you're right, Sanjay, because if you remember last year, last quarter is where there was a turn of growth on retail protection. That was a quarter where we had grown at 27-28% for us.
Yeah.
So to that extent, the growth numbers will get moderated. That turnaround started to happen from November, December onwards. So you're right. The very exponentially high numbers that you saw in quarter 1 and quarter 2, now those numbers do not reflect in quarter 4. However, few months here and there, you know that this business is very active business. Number of participants in protection has increased, competitiveness has increased. One-off month here and there, you may see, one of the insurers taking a lead over others, but it is all momentum. The situation is changing every month. But answering your question, growth numbers will definitely be more normal from quarter 4 onwards and not in line with what we saw in quarter 1 and quarter 2.
Okay, perfect. Thanks for the answers.
Thank you. The next question is from the line of Shobhit Sharma from HDFC Securities Limited. Please go ahead.
Yeah, good one. Am I audible?
Yes, Shobhit.
Sir.
Yeah. So I have a question. You mentioned, sir, that we will be able to grow Q4 and years to come. So my take is, are we going to suffer to the product mix? Are we going beyond % on look side?
So Shobhit, there are no hard limits on any of our product lines. Let the product mix evolve to what the customer chooses. However, we are also very cognizant that we cannot let one product line dictate the entire mix. We've seen those issues in the past, and we want to maintain a diversified product mix as well as distribution mix.
Okay, sir. Thanks. Another question is, sir, you mentioned that we have seen that business has shifted from non-par to the ULIP side. So will we be able to see it going forward as well?
That would depend upon, so as you look across the coming years, that would depend upon where the final IRRs for customers are in relation to other financial products as well, and the general market environment from a tech perspective.
And see, our entire approach on managing products is by identifying the right pool of customers who may find those product categories relevant. So it's not about making a choice on a product and then going and pushing that product, whichever customer segment that our distribution is facing. I think the advantage of diversified distribution is that you have access to varied profiles of the customers, and we drive our product mix by reaching out to the customer profiles where these products are more meaningful. That's going to be our approach, and product mix is the outcome of the conversions that we reaching out to those profiles and see about the relevant products which are more appropriate.
Okay, sir. And last one is that you said that we have witnessed a growth in like 5% on the overall, because that the 5 is a business of the non-par has shifted towards ULIP, or is this different?
Yeah, same thing. Non-par, we have seen migrating towards participating and unit products. The general optimism around markets gives way to unit-linked business and essentially a high return product in comparison to guaranteed is participating product. In a general optimism scenario, you will actually see product followed by participating product picking up steam. That is what migration has happened. Within affluent segment, that relative to other products available in investment space, it is still most tax efficient. That is what is bringing back more than 5 lakh growth from quarter 2 onwards. That's what we have been.
Okay, thank you.
Thank you. The next question is from the line of Madhukar Ladha from Vama Wealth. Please go ahead.
Hi, thank you for the follow-up. So my question is at sort of product level margins have come off, and you've said that commissions were redesigned across channels. Now I want to know whether when this happened, because if it's happened sometime mid-year, then you see a further impact on margins going in 4Q and then all the way in FY25 as well, or is it been so right from the beginning of Q1? So that's one.
Yeah. So answer that, Madhukar, commissions have started taking shape in the new guidelines, the new regulations all through the start of the year. As we mentioned earlier, this is going to be a flux as we try and figure out what the right levels would be. Going forward, as we get into the next financial year, we'll leave them to be far more stable.
Understood. And what would be the impact on sort of gross VNB margins due to increased commissions? Some sense in terms of basis.
It's all reflected in the cost ratio, which is what we reflect at 9 months.
Got it. Okay. Thank you.
Thank you. The next question is from the line of Supratim Datta from Abbott Capital. Please go ahead.
Thanks a lot for giving the opportunity for a follow-up question. Again, on the quarter guidance of 10% growth, assuming that March declines by around 10%, that means that you have to grow by around 30% in Feb to hit that 10% on a base of 33 billion last year. So, what gives you confidence that, again, 35% is not a small number? How do you plan to hit that in Jan Feb? Is there a new product launch that you're planning, or is there something that's in the pipeline that confidence?
So, Pratim, I mentioned it to other participants as well. It's going to be a combination of what we do on product, what we do on productivity enhancement, new capacity, and what we are initiating as specific initiatives around channels. It's a combination of three. At this point in time, it's very difficult for me to divulge details about what drives how much of it, but broadly, this is going to be a combination of these three.
Okay. Got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to the management for the comments. Over to you, sir.
Yeah, thank you very much. And we will continue to balance three things, which is growth, profit, and risk and prudence, as always. And keeping customer at the center. And customers, because there were a lot of questions on that. Customer centricity, I must again add, is not conflicted with any of the three. It is growth and profitability and our risk and prudence. Thank you very much. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of ICICI Prudential Life Insurance Company Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.